Welcome to Mizuma's webinar about what's deductible. It is tax season, focused on taxes. One of Mizuma's primary missions is to save you taxes, right? Our goal is to keep you organized with your books and everything together, keep you compliant, IRS off your back, and then also to make sure that you're paying as little taxes as possible. So today, we're going to talk about what's deductible because that's how we save taxes, by getting as much deductions as possible. The organization, the agenda here today, we're going to talk about the definition of a deductible expense, ordinary and necessary, how much you'll save by deducting things in general, and then we'll talk about some specific examples of deductions, okay? All right, so the IRS has put out some very broad and vague definitions about what is deductible in a business, all right? Now, I like broad and I like vague because that really opens it up, right, for us to define exactly what we can deduct in our business, all right? The first statement that they provide for us is that an expense must be ordinary. In order to be deductible, the expense must be ordinary, which means common and accepted in your trade or industry. Okay, so think about your business. Pest control business is one that we often use as an example in our webinars. So what is every pest control business having to purchase in order to operate their business? Right? They're traveling around, so they got lots of gas, and they've got the pesticides, and they've got supplies and tools. There's things that are common in that industry that everyone's deducting because it's ordinary. It's common to that industry. So you can think about what you're doing, right? And about the other people in your industry, the other businesses in your industry, and think about what are the types of expenses that they are incurring. Maybe you go to a conference or something and you're talking among partners in your business, and you find out, oh, they're deducting their printer or their truck this way, or anything, right? So anything that is ordinary across your trade or industry, the IRS says you will be able to deduct on your business. Now, the second qualifying factor is that they say it also must be necessary, all right? An expense that is helpful and appropriate in your business. Okay, so it's kind of a two-pronged. It's got to be ordinary, everybody doing it. And then it's also got to be necessary to advance the interests of your business, to allow your business to operate. Okay, so this is where it can be a little bit gray, and we're going to talk about some gray areas a little bit later. But if the expense is ordinary and necessary for you to do business, then you should be deducting it. All right, for example, something necessary, a phone these days, right? A cell phone. You can't run a business these days without a cell phone. The IRS is never going to question or doubt, I don't imagine, a cell phone expense for you and your business. All right, so those are the two elements, two definition-based elements of what is deductible in a business. Now we're going to talk about the basis. So this is kind of speaking to when is something deductible, all right? On a tax return, you choose cash, accrual, or hybrid as the basis for your tax return. So cash basis is the most common, right? That's the default treatment, is that you're a cash basis taxpayer. That means that when you spend money, when you pay the cash, when you swipe the card and actually purchase something, that is the day on which that expense is deductible, okay? And the second option is accrual based. So that says when you incur the expense, even if you haven't paid for it yet, as soon as you get a bill from somebody, that's the day that it's deductible. And hybrid is kind of a mix between the two, and we won't get into the details of that. Now, one of the the things to remember is that it works on both sides of the coin. So if you're an accrual base, that idea of just getting the bill and being able to deduct it at that time, it might sound good, right? Because you get to deduct the expense even though you haven't paid for it yet. However, it works on the income side too. So as soon as you send an invoice out to somebody and you've earned some income, even though you haven't received it yet, you're going to be recognizing the income on your tax return. So cash basis is the default and usually is the most beneficial for the small business owner to use. Okay, so remember that the deduction happens when you actually pay for it. Now, we get a lot of questions right now about this year end, right? So maybe you write a check before the end of the year and you send it to one of your vendors and they don't cash it until January, right? So us as your bookkeepers, we don't see that expense on the December bank statement. So if we didn't know any better, we wouldn't deduct it. Now, the client, you as the business owner, should be informing your bookkeeper that, hey, I wrote a check and delivered it, sent it off in the mail, delivered it to the vendor before the end of the year. In that case, you deserve the deduction, even if it hasn't. They could cash the check in February, but you still deserve the deduction because you actually wrote the check and delivered it before the end of the year. Now, if you write the check and you date it December 31st and you hold on to it, that doesn't count. Okay, so you got to actually write the check, send it off in the mail, deliver it to the vendor before it will be deductible. But watch out for those. Sometimes they make a big difference at the end of the year. All right, so that's our basis for deductible. When things are deductible. Now let's talk about what deductions do for us. Okay, so when you are evaluating on whether to make a purchase for your business, a computer or some supplies or furniture or something like that, and you want to be able to crunch a little bit in your head and say, well, what is this saving me by doing this, right? It's important to know. It's important to have at least a rule of thumb to go by, so you're not having to guess or call someone before you make a purchase, right? So here's our formula. And it's very simple. We've got the deduction. So how much is the item going to cost you? $1,000 in this case. Multiply that by what your tax rate is. So and your accountant or whoever did your tax return should be able to tell you that really quick, what your tax rate is. And it's that simple. You multiply the cost of the item that you're planning on deducting by the tax rate, and that gets you how much taxes you're saving by making that purchase. Okay, so very important to have that in mind and to realize the significant savings that is coming. If you decide to make a purchase of $1,000, for example, it's really only costing you $750 because by making that purchase, you're deducting it and getting to pay that much less in taxes. All right, so here's how you determine what you're saving, what deductions or write-offs, as sometimes they're called, what that's actually doing for your pocketbook. All right. Okay, now let's talk about some examples. Just kind of listing out some examples here. Vehicles, business vehicles, phone, equipment, supplies. You know, any equipment or supplies that are ordinary or necessary for you to use in your business, they're all deductible. I mean, you look around your office, look around your home, anything that you're using in your business should be paid for with the business card, business funds, and deducted. Contract labor, so anyone who's helping you, same employees that are helping you in your business, of course, payments to them are deductible. Business meals are deductible. There was some question about, with the new tax law, the new 2018 tax law, that eliminated the deduction for entertainment. everyone was wondering, does that apply to business meals also? And our understanding and our interpretation right now is no, it does not apply to business meals. You can still deduct business meals. Now, when they go on the tax return, they are cut by 50%. But business meetings over a meal, still deductible. Entertainment is not. So keep that in mind. Some more examples. Travel. So if you're traveling on business with a business purpose, that's definitely deductible. Insurance, website development, software, taxes. Now taxes, with the caveat or the exception that federal taxes, your federal income taxes are not deductible, all right? But state taxes, payroll taxes, property taxes, things like that are deductions. Marketing and advertising. Oh, we got insurance on there again, but there are lots of different types of insurance, right? We got health insurance, then we got business insurance, general liability insurance, we got workers' comp insurance, lots of different kinds of insurance that if those things are being purchased for the business, they should be deducted. All right, let's talk about some special deductions that kind of work similarly, but have been changing a little bit recently. So capital assets like a vehicle or a forklift or maybe a large piece of office furniture like a big conference room table or basically anything that costs you over $2,500, there's kind of the rule of thumb there. Anything that costs you over $2,500 is generally considered a capital asset, which means it used to be that you'd have to capitalize that asset and then depreciate it over the years, right? Now we've got this great benefit with the new tax bill. This is one of my favorites, really, with this new 2018 tax bill. It went into effect in 2017. This portion of the bill applies to 2017, where they are now allowing us to fully deduct capital assets. So if you're buying an asset and it's being used in the business, you get to write it off just like it was a supplies expense. So it's fully deductible in that first year. Now, and it doesn't matter if it's used or new. There used to be some little details in there before that it had to be new in order to get that full deduction. No longer. All right. So capital assets, that's a big benefit to you as a business owner if you have the opportunity to buy some capital assets. All right. Or if you did, make sure that your 2017, whoever's doing your 2017 tax return knows that that can be fully deductible. All right, another big one that often ends up saving clients a lot of taxes is retirement contributions. Okay, there's two types of retirement contributions. One is the traditional IRA, right, where we're all maybe familiar with the ability to contribute $5,500 or $6,500 into a traditional IRA before the end or before your tax returns filed, and get that as a deduction. Now, that's good. $5,500, $6,500 if you're over 50 is a good deduction. But there are business plans, employer or business plans like the SEP IRA, a 401k plan that often will enable the business owner to put a lot more than the $5,500 into an IRA. And the same rules apply where you are able to deduct it in the 2017 tax return, for example, even if you make the contribution in 2018. So you can have the tax returns drafted. We do this all the time. We draft the tax returns, show the business owner what the tax situation is, how much taxes they may owe. And then they decide, they say, how much would it be if I contribute 20 grand to my SEP IRA? And if they meet the qualifications and can contribute that much, we say, oh, well, that would be great if you can contribute 20 grand. That gets your, we use our little tax savings formula, the same formula. You're in the 25% tax bracket. You put 20 grand away into a retirement plan for your future. you're saving 25% of that, $5,000 off of your tax bill. So often that's a very good way to hedge taxes if you are in the position of owing taxes. And it's a great deduction for the small business owner. All right, moving on now to some gray areas that often come up in this discussion about deductions. Sometimes you purchase things in your business that are used for both personal and business, right? So you may buy a car. That's really the best example. And 75% of the time you are using that vehicle, that truck, that car to drive around and see clients. If you are using it 75% of the time to drive around and see clients, you get to deduct 75% of the use on as a business deduction. That 25% of the time that you're using it to run the kids around or go shopping for groceries, for non-business related items, you don't get to deduct that as a business expense, and there's no personal deductions associated with using your car typically. So really that all that requires, when you have these gray areas, like maybe a car or I suppose a computer that is sometimes used by your high schooler at school and sometimes used by you in your business. If that's the case, then you need to split that time, right? Or evaluate how much time it's used in both, and then you split it on the tax return to determine how much of a deduction you get. Okay, so and that applies to travel. That applies to kind of any area where there's a personal benefit coming out of this expense, right? If it's not 100% business benefit, then you may need to split it. That's the idea that the IRS has behind this meals, this 50% slash in the meals deduction, where you only get to deduct 50% of the meal. Well, they're like, okay, you took a client out and they ate half the food and you ate half the food. There was a personal benefit. We're not going to let you deduct the whole thing. All right, so moving on now to gray area number 2. The car is a big one. I talked a little bit about the personal versus business use of the car. But what about the way you deduct a car? There's 2 methods, the mileage method and the actual expense method. Okay, mileage is simple. You multiply the number of business miles that you drove during the year by the tax or the IRS rate for mileage, which I think is like 53 cents, 53.5 cents or something this year. So that requires you to keep a log and to be able to support those business miles driven. And it's as simple as multiplying by the IRS mileage rate to determine what your deduction is. And if you've got a lot of miles, over 10, 15, 20,000 miles on your vehicle for your business, then that usually ends up being a much better deduction for you as opposed to the actual. The actual method is where you depreciate the car. So remember, on the mileage method, there was no depreciation of the car. It was purely miles. In the actual method, you depreciate the car, you deduct payments for insurance, you deduct the payments for tires, repairs, and maintenance, you deduct the gas. So you're taking what the vehicle actually costs you as a deduction. So once you purchase a car, use it in your business, and choose one of these methods, you have to stick with it. Okay, so when you're first starting to deduct a vehicle in your business, it's good to have someone look at both options and see what's best, actual or mileage, because once you pick one for that vehicle, you have to stick with it in the years to come. All right. Okay, home office. Again, two options, two ways to get a deduction for the home office. This is a fairly new, within the past 3-4 years, the IRS came out with this square footage method, and they now call it a safe harbor method. The home office was historically abused quite a bit, right? And so small business owners would take too much of their home as a deduction in their business. So the IRS said, we're going to give all you small business owners a safe harbor way, a safe way to take this deduction. And if you do it under this safe harbor method, which is the square footage method, we won't ask any questions. Okay, we're gonna just assume it's fine. So that basically, it's as simple as taking the square footage that is used exclusively for your business, multiplying that by $5. It's that simple. So it doesn't end up being a huge deduction, especially because they say the max square footage that you can use is 300 square feet. So the highest deduction that you can get for the home office under that method is $1,500. However, you know the IRS is going to be off your back about it, all right? And you know you don't have to do the work. You didn't have to do the work that it takes to use the other method, which is the allocation method, which requires you to track all of the expenses associated with your home, utilities, property taxes, mortgage interest, all of that. And multiply all of those expenses in total by a ratio, which is your home office square footage divided by your total home square footage. Okay, so you add up all of the home expenses, multiply it by the percent of your home that is being used as a home office, and there's your home office deduction. You can see where that might get abused. Historically it was, so the IRS really drilled into that, and that would often be one of the red flags, or one of the flags that would be thrown to initiate an audit by the IRS. So often small business owners will elect to use the square footage. It's easier. You may not get as much, but you know you're safe with it. Now this last one, gray area, you know, we have some consultants or some photographers, or businesses where you are required to present yourself to your clients, and the way you present yourself significantly affects their perception of you and their willingness to work with you, right? So if you can justify that things like this, hair, cosmetics, uniforms, are ordinary and necessary for you to do business, then it's definitely deductible, right? But the important thing is justifying ordinary and necessary in those areas. But by no means, if it does meet those qualifications, you should not be passing that up. All right, so today we have covered deductions, what you can save, how that savings happens a little bit, and also quite a few examples of deductions that might apply to your business. But even if the ones we listed here today don't, this was not an exhaustive list. This was not meant to be, here's everything that's deductible. We can never cover everything that's deductible, but hopefully we gave you a list and an idea and a framework to use to apply to your business. Thank you for watching Mazuma's webinar today. We'll see you next time.